for more on all of this, let's bring in Rich Greenfield of LightShed Partners, who's been lurking in the background, listening to our conversation, shaking his head and disagreeing with most of it. Rich, why is that? What do you take issue with?
Well, I could not disagree more with the commentary that subscriber growth is going to be the driving factor here. You know, the reality is when you move to advertising, there's a huge opportunity to bring on new revenue streams and to ramp advertising. And remember, they're moving towards telling people, hey, if you've been sharing your account with your daughter who lives someplace in another state or with a friend who lives across the country, you're going to either have to start paying more for that person or they're going to have to start getting their own account. And it's going to really put a lot more focus of this company, investor-wise, actually on revenue growth. And I think, like, if there was anything you could point to in this print, it was the guidance of only 8% revenue growth organically in Q1. I think that's a very conservative number. They just, they just exceeded expectations a little bit on revenue, but I do think that 8% is going to prove low, and you're going to see that 8% move into the upper teens, if not 20%, as the year progresses. And so I think the real number to focus on is, can they get back to high teens revenue growth? That's what investors are going to care about, less so on subscribers specifically.
Yeah, I mean, I think that just to clarify the points that we were trying to make on the desk, maybe we didn't make them very clearly, and that's entirely possible, is that it seems like investors in the after-hour session, at least, are very excited about the magnitude of the subscriber additions. And we were just saying that it's too bad that this is happening at a time when Netflix is trying to tell investors that that is not the metric to focus on, and it is the traditional metrics of profits and revenues, et cetera, to focus on, and not sub growth at a time when subscriber growth, the cover was knocked off the ball this quarter. Rich, that was, do you disagree with that? Rich is frozen.
Well, I
guess he's speechless. He's speechless at this whole thing. But getting back to a double-digit percentage revenue growth, so what would Netflix, what is the expectation? That Netflix is a value stock or Netflix is a growth stock?
Well, it's probably neither right now. At some point, it looked like it was a broken stock. But if I think about Netflix, let's acknowledge they are the largest player. Let's acknowledge that streaming will consolidate, and they are going to be a consolidator. Let's acknowledge that they are profitable. So, yeah, I think you start to look at it from a value perspective. And I know that's relative to a peer group, but I will go back to the fact that they don't want you to focus on sub growth because, in fact, this is becoming a more sophisticated company. It makes a lot of sense. In other words, it's kind of like we talk about software companies. What multiple of sales are they? If I'm a streaming company, it's really just, it's been only about subs. And to some extent, Disney was over-rewarded in terms of their rapid sub growth. And depending on how you're counting Hulu and all the other parts of their empire, I think they almost got too much credit.
Rich is back, so I'm told.
All right.
Let's bring you back in.
Look, the thing I would think about is the $3 billion of free cash flow. There were so many investors and media executives who said Netflix is never going to make money. This is a business that will never work. Streaming is a bad business. We've heard that so many times. And you've seen a lot of media companies who go now, they're rushing to get to profitability and they don't know how to do it. So they're starting to cut costs, cut marketing, cut content spend. Here you have Netflix. They're spending $17 billion a year on content, and they're going to generate $3 billion a year of free cash flow, at least, up 100% year over year, and off to the races over the course of the next few years. And so I think the real thing to think about, as everyone is looking at what to do with Netflix from here, is what does this mean for the rest of the sector? Do you think the Peacocks, the Paramount Pluses, the HBO Maxes, will they be able to sustain the level of investment, or does it give Netflix more of an advantage in 23 and 24?
Where did that free cash flow come from? Because the street was looking for, I think, negative $160 million. It came in at to your point, 332. I mean, that's pretty incredible against a quarter that the metrics, I mean, I'm not the brightest bulb in the fixture, as people watch the show have come to learn, but the math doesn't sort of make sense to me.
Well, remember, as you start to regrow revenue, so as revenue starts to grow double digits or more, and you're starting to, again, at $17 billion of content, you can't keep spending. I mean, they create so much content that you don't need as much more incrementally, especially if others are scaling back. And I think the thing that that investors have not focused enough on is that the legacy media industry is going to start scaling back how aggressive they are in streaming as they rush to profitability. You've heard it from Bob Iger. You've heard it from David Zaslav, like executive after executive. that's going to actually mean less spending, marketing spend from Netflix on a relative basis. The end result, though, is tremendous free cash flow over the next few years. And that's something that no one was expecting for Netflix.
So, Rich, does that show that there is a way to profitability for the legacy media companies that have entered streaming more recently, this Netflix quarter? Or does this tell them that Netflix is so much in the lead that it's just sort of a competition that they cannot win?
Can you hear me?
Oh.
Okay. We're obviously having many gremlin issues with Rich. We'll thank Rich at this point. Thank you, Rich Greenfield of LightShed Partners. What do you think, Bonawyn? Does this make Disney look better? Does this make Disney look worse?
I think it makes them all look worse. I mean, when you really drill down into profitability, and then you look at user engagement and how long the actual users are engaged with the interface, right? And you look at Netflix and it's multiples of what others are, which speaks to its ability to kind of drive ad-related revenue. So I'm with Tim. You will see consolidation. With that said, I'm going to circle back here and say I still think that the focus should not be on subscriber growth. It should be on churn and profitability. And with those things abated, I think that speaks to where the others have to make up ground.
Steve?
Yeah, I agree with that 100%. And I agree with what you had said, Melissa, to Rich. I agree that it should be about fundamentals. It's not. It's about sub growth. That's why we see the stock up post earnings. So I think they're going to get a pass. Tim brought up a good point. This was a company that people thought was going to be written off. It's not after this print. So it's getting a second look, a third look, a fourth look. I think there's probably a little bit of a balance. I owned the stock below 300. I sold it yesterday. I'm not going to be buying it back right now. I want it to have a clear, defined direction.